All right, in this video, we're going to go over the real estate vocabulary you want to learn to become a more savvy real estate investor. So bear with me. This video is going to be one of the longer videos because we've got a lot of slides here to go through. Each slide has its own vocabulary word. I think there's at least 50 vocabulary words here. So carve out some time in your day to just sit down and really study these vocabulary words. And we're going to try to link a list or a PDF or a Word doc, some kind of document nearby this video that you can also download to review all of these definitions and all of these words, right? So here we go with the adjustable rate mortgage. This is a loan product that banks offer, and it's with a mortgage rate, an interest rate that adjusts annually up or down depending on the market instead of remaining fixed or locked in like a fixed rate mortgage would. So if you get an adjustable rate mortgage, there might be a period of time where that loan rate locks, but after that period ends, the rate of the interest rate could start going up or it can start going down depending on what the mortgage interest rate market is doing. So there's pros and cons to it, but it's an option if you are looking into financing. Next up, we've got agent. A real estate agent, for short, is a person who works for a seller, a buyer, or potentially works for both during a real estate transaction. Amortization. This is a period in which a loan balance is gradually paid off from a mortgage payment. This includes both principal and interest. So when you go to the bank and you get a mortgage, they're going to print out an amortization schedule, which is going to show you basically a calendar or a schedule that shows you all the payments that are due. And it's going to show you over the life of the loan how each payment affects the loan balance. You're going to see each payment amount, how much is interest, how much is principal, and you're going to watch how the loan balance goes down from month to month during the entire duration of that loan. So ask your lender for an amortization schedule if you want to kind of dive deeper into what your payments are doing each month and how much loan balance you'll have after month 10 or after month 18 or after month 35. You can pinpoint the exact amount your balance is going to be based on this amortization schedule. Appraisal. This is the estimation of a property's market value by a licensed appraiser to assist banks in making loans to home buyers. So in other words, if you go to get a loan from the bank, they want to make sure that the loan is actually supported by the property's value. They want to make sure that property value is enough to cover the loan, because if you default on the loan, the bank's going to take back the property from you and they're going to have to sell that property, and they want to make sure they can get enough money out of the property when they sell it to cover the loan payoff. So they're going to hire an appraiser to go out and appraise the property's value to let them know what they think the value of the property actually is. Now the appraiser, this is actually the person who goes out and visits the property and does the appraisal. Appreciation. This is the annual increase in a property's market value. All right, so a property, every real estate property has a value given to it. This is determined by the buyers and sellers in that market. So when buyers and sellers come together and they negotiate on a deal, they determine what value they think is worth exchanging the real estate for. All right, so when a ton of buyers come together in a market and a bunch of sellers come together in a market, we start to see average sale prices across the market, okay? So if 1 month there was maybe 200 transactions and the average sale price of those 200 transactions combined and averaged out might be, let's say, $150,000. That's what the average house sold for out of those 200,000 transactions that took place in that market. Now maybe the next month another 200, maybe 250 transactions took place. A bunch of buyers came together with a bunch of sellers and they made deals happen. Maybe the average sale price in the next month was $155,000. So right there, the price went up $5,000 from month to month. This is called appreciation. It's when property values go up over time. So each year, housing values go higher and higher as more and more people have more and more income to support paying higher prices for the real estate. Assessment. This is the value that gets assigned to your home by a government tax assessor, which is used to calculate property taxes. So a property tax assessor goes out into every neighborhood and they look at every piece of property in the area, whether it's a certain zip code or a certain township or a certain city. They go out and they look at every single piece of real estate. And it's a lengthy job, but they get it done over several months, and they assess a value to your property. And then what they'll do is they'll go back later and they'll take this value and they will do some sort of multiplication ratio to it to try to determine how much you owe in property taxes. So if you want to pay less in property taxes, try to talk with the county or the city and get them to lower your property's assessed value, and that'll push down the amount of property taxes you have to pay. All right, a buyer's agent. So a buyer's agent is just simply a real estate agent, but it's one that specifically works for the buyer. They represent the buyer in a real estate transaction. So they have the buyer's interests at heart. Capitalization rate, also known as cap rate. This is a term we get into when we deal with multifamily and commercial real estate. So it's a rate that's used to determine the property's value based on the net income. So with apartment buildings, so cap rates calculated by dividing the net income before debt by the current market value of the property. So just like there's the average sale price of houses, there's the average cap rate of investment properties and multifamily properties. So every time an apartment complex sells in your market, there's going to be an analysis done to see what the cap rate was that property sold for. And again, if there's 200 transactions in a month or in a year of different apartment buildings that all sold, you're going to have 200 different pieces of data to look at to see what the cap rate was for each of those transactions. And you're going to average them together, and that entire market as a whole is going to have an average cap rate. So this might be 8%, for example. So what this means is that the net income of the property was 8% of what the property's value was. So if a property has, let's say, $80,000 worth of income coming in a year from all the different tenants, and that's net income, that's after we've already subtracted all our expenses to operate the building. So $80,000 of net income is what goes into the investor's bank account as profit. Well, $80,000 would be 8% of $1 million. So if we did the math, we divided $80,000 of net income divided by a $1 million sale price of the building. If the building sold for $1 million, that would be an 8% cap rate. So cap rates are just one way to value apartment buildings. If you see across your market that cap rates are typically around 8% and you've got income of $40,000, you would just take that $40,000 and figure out what that would be 8% of. In this case, $40,000 would be 8% of $500,000. So you could price your building to sell for $500,000 since you're producing $40,000 of net income, which would result in an 8% net return on investment for an investor. So that's all cap rate is. It's basically the net return an investor would make on their money, on their investment. Whew, all right, we got through that one. That was a long one. I'm sorry, guys. So closing, this is the next vocab word here. So closing just refers to the process of a real estate transaction where the deed officially gets transferred over from the buyer and the seller. So the seller's going to give their deed away to the new buyer, and now the buyer's going to take title and their name's going to be on the deed. And then when they go to sell the property someday, they will give that deed to the next buyer. And so there becomes this chain of title where the deed gets passed from buyer to buyer over time. So closing is just simply the process where that takes place and the deed gets passed from the seller to the buyer. Now, a closing will typically take place in like a title company. They're the ones that do all the research to make sure that the chain of title is correct and that we've got the correct order of ownership on this property so that there's no misunderstanding of somebody who thinks they still own the property and they come, years later harassing the current owner saying that they still own the property. So title companies serve an important role of checking out the title, doing a title search, providing title insurance, and they handle all the closing documents that need signed to officially transfer the property from one seller to one buyer. Closing costs. These are the different costs that are associated with doing a closing transaction. So things like commissions to your real estate agent, inspection fees if you're going to have inspections done on a property you're purchasing, When you have title work done on a property, a title search, title insurance, you're going to have to pay fees for that. You're going to have to pay for property taxes, insurance, and the closing costs, so that all these different costs combined constitute what a closing cost is. Commercial. This is a zoning classification for property that refers to property used for business activities such as retail, stores, offices, sometimes farms. Farms are typically agricultural, but it just depends. So commercial is more just business zoning, so property that is zoned for business purposes. Now there's also residential. That's a different classification of zoning, and that is for housing, for people to live, whereas commercial is for businesses. Comparable market analysis. This is an evaluation of similar recently sold homes called comparables or comps. And these are, houses that have recently sold that are nearby the current home that you are looking at buying, the intended home that you're trying to either buy or sell. So a comparable market analysis basically just goes out and looks what the average sale price was of a bunch of different homes that are located close by, so that you can get a rough idea of what your home would be worth as well. Because if you're seeing, other 3-bedroom, 2-bath homes, just like your home that's a 3-bedroom, 2-bath home, and similar square footage, similar age, similar condition, then if they all sold for around $140,000 to $150,000, then your home should probably sell for $140,000 to $150,000, just based on doing a comparable market analysis. Comparable sales, the prices of houses that have recently sold with similar characteristics to the house you are currently valuing. So the comparable market analysis is just going out into the market and doing like an overall analysis of the market. Comparable sales, these are actual like the individual property sales data that you're looking at. So the two kind of go hand in hand together. Construction loan. This is a type of loan that covers the construction cost of a new home being built by a builder. So if you're going to build a house, you have to go out and get a construction loan to do so. Contingencies. These are clauses that get put into different contracts that allow a buyer to not be forced to actually purchase a property if certain conditions or contingencies are unsatisfactory, either structurally or financially. So one contingency, for example, is the inspection contingency. You can have this in a purchase agreement, and it basically lets you back out of a contract with a seller if you find out the property has a bunch of unrealistic problems that cannot be fixed, or maybe it's got a bunch of problems that the seller is not willing to take care of and fix before letting you take over the property. So it kind of protects you. If you thought the property was worth $150,000, it looked like it was in good shape and everything was good and all was well, and then you go do inspections and you find out the structure of the house is actually cracking and it could fall down if it's not fixed. Well, now the house wouldn't be worth $150,000 anymore, because you now found out it had issues that could potentially affect its value. So you're going to ask the seller to go ahead and fix those issues. And if the seller refuses, well, then that's one of those contingencies you can use in a contract to back out of the deal and get your earnest money or your deposit back without losing it. Counter offer. This is where a seller will send back a new or adjusted offer that differs from the original offer sent by the buyer, and vice versa. If you send an offer to a seller to purchase the price for, let's say, $100,000 is your purchase price, and they're asking $110,000, the seller might counter you back at $110,000. That's what they originally listed the price at. Or they might counter you back at $105,000. They might come down a little bit, but they're still countering you to where you have to go back and decide, okay, do I want to pay $105,000 or do I want to counter them again? So you can counter them again back at $100,000. So counter offers are just where you go back and forth in negotiations until you settle on a price and different terms of a contract. All right, the deed. This is the legal document that determines who has ownership of a property. This is the document that gets transferred from seller to buyer at closing. Default. This is failing to make loan repayments by the required deadline. So every month you are responsible for paying the mortgage. You've got a mortgage payment you got to pay, and you've got a certain deadline to pay it by each month. If you fail to make that loan payment during that deadline, you have defaulted on your loan. If you default on your loan, this could eventually lead to foreclosure, where the lender would take back the property after they file foreclosure and go through a bunch of legal proceedings to legally get the property back from you as a result of you defaulting on the loan. Down payment, this is the amount of money that gets paid up front for a property. So some lenders are going to have stricter down payments than others. Some lenders are going to require 20% down as a down payment, where they're only going to lend 80% of the loan, of the purchase price as a loan. So look into different lender options, see which ones have different down payment requirements. And this is how much money you got to come out of pocket up front, and then the bank will fund the rest of the deal with a loan. Dual agency. This is when a real estate agent represents the seller and the buyer in the same transaction. So let's say you are a listing agent and you are listing a property for sale, and all of a sudden you come across a buyer who contacts you and says, hey, I want to buy this property. This is the listing that I'm interested in. Well, since you happen to be the listing agent, you're representing the seller, but you also have the buyer contacting you, asking you to represent them. So you become a dual agent where you are representing both sides of the deal, or both parties, and you have to disclose this to both sides. You have to say, hey, seller, I'm actually working with the buyer. Hey, buyer, I'm also working with the seller. You got to let both parties know you're working with both parties. You are a dual agent. That way there's no sort of, shadiness going on where the seller might think that you're trying to cut a deal that's best for the buyer, or vice versa. The buyer thinks you're trying to, cut the seller a better deal and trying to help the seller out better. All right, earnest money. This is the sum of money that gets submitted with an offer, and it shows, a buyer is serious. Sometimes earnest money is not required, but it's pretty common in most transactions. It's like a way of saying, hey, I'm a serious buyer if I'm going to go ahead and put $1,000 down today as earnest money. So if you end up actually buying the property, the earnest money just gets applied to the purchase price already as your down payment. So then you just have to come up with the remaining balance that's left when you subtract the amount of the earnest money off the purchase price. Now, if you back out of a deal, you may or may not get your earnest money back. Usually it secures a contract. So if you end up violating or breaking the rules of the contract, you could forfeit your deposit or your earnest money as damages to the seller. So that's where having contingencies in your purchase contract can actually help you back out of a contract legally and get that earnest money deposit back. Equity. This is the financial value above what is owed on a property. So it's the surplus, the excess, the profit. So if you bought a $100,000 property and you put a $20,000 down payment, you would take a loan out for $80,000 today. So you would have $20,000 of equity today in the property, because that is the down payment, the cash amount you put down into the property. You only took a loan out for $80,000. So when you sell the house for $100,000, if you turned around and sold it tomorrow, you would pay off the $80,000 loan. You would get back your $20,000 that's left if you sold it for $100,000. So that $20,000 is what's called equity. So as a property's value goes up over time, maybe in 5 years from now, the house is worth $200,000 and you sold it, you would now have the original, $20,000 you put down, plus you'd have the additional $100,000 that is gained in value since you bought it at $100,000. So you would now have $120,000 of equity, and then you'd still have that $80,000 loan that you would pay off out of those $200,000 funds you'd receive for the sale. Now again, when you're paying down a loan, part of the loan pay down is principal. So after 5 years, you probably would also have built up some other equity from principal pay down of the loan. All right, escrow. This is a neutral third party or an attorney that handles the exchange of money and documents between a buyer and seller once a mutual offer has been accepted and the parties move to closing. So escrow is basically the middleman. It's that escrow account where your money goes. That way it doesn't go directly to the seller right now. You have to wait. The seller can't access the funds until the deal has closed. So the escrow account kind of just holds those funds. It's like a neutral third-party account that neither the buyer or the seller actually owns or controls. It's actually usually the closing company that controls the account, or the attorney that's controlling the account. And it also includes, all the documents and stuff that go between the buyer and seller. So it's a way of having a third party kind of handle the closing. That way they can make sure everything is done fairly and no side is getting ripped off in the deal. All right, fixed rate mortgage. This is an interest rate that stays constant over the entire life of the loan. So when you get a fixed rate interest rate, it is locked in. You are good to go for the duration of the loan. So if you get a 15-year loan or a 30-year fixed rate loan, you'll keep that same interest rate the entire time. So you don't have to worry about interest rates going higher in the mortgage market. You still have your locked in rate that is lower. And so you're essentially saving money, because if you had an adjustable rate that would be going up when the mortgage market goes up, you would be having to pay more in interest every time the rate goes higher and higher. But with a fixed rate, you just pay the constant interest rate over the life of the loan, and it could save you money over the long haul. Foreclosure. This is a property that defaulted on the loan payments. It's a person who, defaults on their loan, and they end up having to go through foreclosure, which is the process where the bank is also ultimately going to take back the property. So if you're buying foreclosure homes, it just means that you're buying houses that the bank has taken back from whoever the buyer was. The buyer couldn't make payments anymore, so the bank took over through the legal process known as foreclosure. For sale by agent, this is a property listed for sale by a real estate agent. So upon selling, the agent receives a percentage commission for their services. So if you see for sale by agent on different websites, that just means the property is currently for sale and it's listed with a real estate agent. So there is a commission tied to that listing. If you are for sale by owner, it means putting up a property for sale by yourself, by the owner. You are not using the services of a real estate agent. You don't have any costs associated with hiring a real estate agent. You're saving money when you do a for sale by owner. But there's not always that good a benefit to save the money, because you might end up, missing out on reaching lots of different buyers and getting the best deal and the best offer on your property. If you were to go with an agent, you could get lots of exposure, lots of marketing that the agent's going to do to get your property seen by as many buyers as possible. So sometimes going the for sale by owner route could actually hurt you. You might think you're saving money, but you just got to be careful, because if you don't do a good job marketing your property, you might get very limited showings or very few showings, and you might get no offers at all on your property, and the property might end up sitting on the market struggling to sell. Homeowners Association, or HOA as it's called in short, this is the group that manages a shared housing complex such as apartments or condominiums. So the HOA board enforces community rules for the tenants and the residents to follow, since they all share the same complex. So it's kind of like a jury duty or a governing board that kind of controls what's going on in the building to make sure the building is being run properly and it's being maintained and upkept. Because when you've got 50 different condominium owners all residing in the same building, there's going to be a lot of fights and quarrels over who's keeping the pool clean and who's doing the landscaping and who's cleaning the windows and repairing the roof when the roof of the condominium complex starts leaking. So all this gets handled by having an HOA or a homeowners association that can, be responsible for making sure that repair guys are coming out and keeping the property looking nice. And there's typically an HOA due or an HOA fee. So this is our next vocabulary word. This is the amount that the owners that live in the condominium complex have to pay as part of their HOA dues each month, so that all this money can get pooled together by all the owners of the building, since they're all sharing the building collectively. And all this money gets pulled together into a fund, and that fund gets used then to go pay the landscaping company, the pool cleaning service, the elevator service that runs the elevators, and that sort of thing. Homeowners insurance. This is the protection you get from damages to a home, as well as liability protection if there's accidents that occur on the owner's property. So having homeowners insurance is super important. in case of a fire or some sort of liability claim that gets placed against the homeowner if somebody gets hurt on the property. Home warranty. This is a warranty that protects the buyer or the seller in case the home has defects and items need serviced or replaced. So if you get a home warranty and all of a sudden the heating system goes out or the plumbing starts leaking, you can look under the terms of your home warranty and reach out and have repair guys or servicemen come out and fix the issue, and you can bill it to the home warranty company and they will pay for it as part of your home warranty policy. Inspection. This is a thorough inspection of a home by a licensed inspector to discover any issues or repairs that need to be made before buying the home. So it's good to have an inspection done. It can reveal any problems that come up with a property, and that can alert you of things that need fixed before you buy the property. So you can negotiate them with the seller, and if the seller doesn't want to adhere to any of these repairs you're requesting, you can back out of the contract due to a bunch of issues with the property from the inspection that you found out about. Interest. This is the cost of borrowing money. It's the cost that you pay back to a lender who's loaning money to you. So they're not just going to give you the money for free and say, here, take this money and go do what you want with it. Instead, they're going to say, nope, you can borrow this money, but you got to pay me it back, and you got to pay it back with interest. So I have to make money on this money that I'm lending you. So if I'm going to lend you $100,000, I want you to pay me back that $100,000 over 30 years. But when you pay it back over those 30 years, I want interest on it. And so when you pay it all back, it's going to be, $150,000 or $200,000 essentially that you're paying back to me for loaning you that money, because I could be doing other things with that money, making money with it. So if I'm going to borrow it or let you borrow it, I want you to pay me that interest. A loan. This is simply borrowing money from another person or an institution to pay for the property. So when you get a housing loan, you're just borrowing money to be able to afford the purchase price of the property. A lien. This is a right to keep possession of a property belonging to another person until a debt owed by that person is discharged. So people can put liens on a property if they are owed money, such as contractors, if they've done work on the home and for some reason the homeowner did not pay the subcontractor off for the work. The contractor could put a mechanic's lien on the property, which gives them possibly the right to take the property if for some reason the homeowner doesn't, get that lien discharged and doesn't pay off the outstanding bill they owe the contractor. In a more serious case, property taxes. If you don't pay your property taxes on a real estate property, the government will place a property tax lien on your property. And they're going to give you so long to pay back that property taxes that you owe. And if you don't, they might foreclose on the property and they might take possession or take ownership of your property away from you. And then it will go to the tax foreclosure sale auction. And that's where other investors can basically pay off your property taxes for you. And now they are the lien holders where you would have to pay them back instead of the government. So we're going to get more into that in another video. I'm going a little too far with this one, but liens are basically strikes against the property saying, hey, you owe us money, otherwise we're gonna foreclose on you and take possession. Listing. This is a term for a property or land that's put up for sale for others to see and purchase on the market. So if you list your home for sale, you're just listing it on the market, which is like putting it up on Zillow or putting it online so that there's other people out there that become aware that your property is now for sale and can be purchased. A listing agent. This is the real estate agent who works with the property owner and helps them list their home on the market for sale. A mortgage. This is the charging of real property by a debtor to a creditor as security for a debt, especially one incurred by the purchase of property, on the condition that it shall be returned on payment of the debt within a certain period. All right, so there's a loan where you give away money to somebody else, you loan them money, but that money is unsecured, right? You could just give somebody money as a loan and tell them, hey, pay me back, and they might never pay you back. It's unsecured loan. However, a mortgage secures that loan to property. So when you write up a mortgage, it says, hey, I am loaning you this money to go purchase this property, but if you don't pay me back this money, I will take possession of your property. I hold the mortgage of the property, so you better pay me back my money, my loan, or else you could risk losing your property. I'm going to get the property or I'm going to get my money, one of the two. So that's what a mortgage does. It basically ties real estate, the value in the real estate, to the loan amount. Mortgage broker. This is the company or person who's going to help a home buyer qualify for a loan or a mortgage. They handle all aspects of getting the loan created and getting the lending in place for the borrower. So if you're going to go buy a home, you would reach out to a mortgage broker. They're going to shop around the mortgage market and see what kind of loan products are out there, what kind of interest rates they could get you on your loan, and they're going to come back to you with a loan that they're going to process and help set up for you so that you can fund a real estate transaction. Multifamily. This is a type of home or building with multiple units owned by one or more parties. So in other words, it's like an apartment complex or a condominium complex. It's a building where multiple people live at once. It's not like a single family house where it's just one single family living in the house. Instead, it's a multi-family property where, there's probably 5, 10, 15, 20, 100 plus families all living on that one piece of property. So typically we see this with apartment buildings or those big, tall condominium towers. The MLS is a local or regional service that compiles available real estate for sale by member brokers, along with detailed information brokers and agents can access online. So in short, the MLS is basically just this big listing platform where real estate agents get on and list all the homes for sale that they currently have, deals signed, contracts signed with clients. So when you get a new listing client, you get a new person who's selling their home, you write up a listing contract with them, and then you go put their property online on the multiple listing service. And this becomes a big database that other brokers, other agents can access to see what's available for sale if they're working with buyer clients. So they can find what's on the market that they can show to their buyers. Net income. This is the amount of income that is left over after all the operating expenses have been paid from the money that is brought in from the property. So a property is going to have gross revenue, then you're going to subtract out all the expenses of running the property, and whatever money is left over after everything's been paid off is known as net income. An offer. This is the price that a buyer offers the seller to purchase the property, as well as any special terms the buyer requires as part of their offer to the seller. So if you want to make an offer on a piece of land, you would go write up a offer contract or a purchase agreement that outlines what price you're willing to pay, as well as any additional terms you want to outline in your contract. And you submit it to the seller as part of your real estate offer you are making to them to buy their property. Pre-approval letter. This is a document buyers should obtain from a lender that provides proof they can afford to buy a home up to a certain amount. This way, agents and sellers alike do not feel like they're being tricked or their time's being wasted. So it basically gives you a way to prove that you've already been financially qualified to purchase a home. That way, people take you seriously and they know that you have the money to back up any offer you would make to them. Principal. This is the amount that gets borrowed for a mortgage loan. The monthly mortgage payment includes both the repayment of the principal and the interest owed. So this is the amount that you're borrowing. So you're going to borrow $100,000, then that's the principal amount that gets borrowed. Each time you make a mortgage payment, you are paying back a portion of that $100,000 principal. So that's why part of your mortgage payment is principal, and then the rest of your mortgage payment is interest that you are paying to the cost of borrowing that mortgage loan. Private mortgage insurance, known as PMI. This is a monthly payment that is added to the mortgage payment when a buyer has less than 20% as a down payment on the property. It protects the lender, that's why it's called insurance, in case the buyer defaults on the loan. So most lenders think that a healthy level of debt is 80%, meaning you put down 20% of the value of the property and the lender will finance the remaining 80%. So again, with $100,000, You put down $20,000, 20% of the 100,000. The lender's going to put the other 80,000 or 80% down so that you have $100,000 total to give to the seller for the property. That's what they assume as a healthy amount, so you're not over leveraged. If you put down less than 20%, they start to worry that you take on too much debt, that it's starting to be unhealthy. So they're going to require you pay what's called private mortgage insurance, known as PMI. And you will make this private mortgage insurance payment on top of your typical mortgage payment until your equity in the property gets to 20%. At the point that you have 20% equity in the home, then the PMI will fall off and you'll no longer have to make that extra PMI payment in addition to your mortgage payment. Property tax. This is the annual or semi-annual tax that gets paid to the government based on a property's value. All right, so every property gets taxed, and this tax revenue goes to help support school systems, road work that they're doing to constantly improve roads and subdivisions and across the city, and it goes to a bunch of other projects that the government puts together a budget every year for. And it's one of the ways they get revenue to cover the budget is they charge people property tax. Real estate broker. This is a real estate agent who is licensed by the state to represent a buyer or seller in a real estate transaction. A real estate broker gets paid a commission. Most real estate brokers also have agents working for them. Licensing for a broker and an agent are different, in case you are confused. All right, so in short, a real estate broker is somebody who runs their own brokerage company, and they might hire a bunch of independent sales agents to work underneath them and represent the brokerage. Real estate owned, also known as REO. This is a classification of properties. It's typically a foreclosed property. So if a foreclosed property is not sold off during a foreclosure auction, the bank will have to retake the property. They have to take the property back. So it becomes a bank-owned property, and it's known as real estate owned, or REO. So if you see the words REO or real estate owned, just know that it went to foreclosure auction. Nobody wanted it, so the bank took it back, and now they're trying to sell it as an REO property. Real estate purchase agreement. This is a legal document that obligates a buyer to buy a property, and it obligates a seller to sell the property. So it's basically just, a legal contract you sign with a seller if you're the buyer, and it obligates you to buy the property and the seller to give you that property on the said closing date that'll be outlined in the contract. Refinance. This is getting a new loan from a lender with better terms, such as a lower interest rate or a lower monthly payment. When home values rise, owners can pull out equity or cash from the value of their home, known as a cash out refinance. All right, so let's say you bought a house for $100,000, you've been paying down the debt on it, and you've got a $50,000 mortgage balance left. You would now have $50,000 of equity in your home, right? So you've got $50,000 of equity, $50,000 of debt. Combine the two together and they make $100,000, which is what your property is currently worth. All right, so you could pull out some of that equity as cash, doing a cash out refinance. This is where you'd go get a new loan. So you might go get a brand new loan for $80,000. It would replace or pay off your existing loan of $50,000, and you would now have a new mortgage for $80,000 on your property. And now you're going to have that cash that comes out in hand. So this new loan that's $80,000, that's the bank basically giving you $80,000. Now you got to take that $80,000. You would have to pay off your existing $50,000 mortgage you already had. And that's going to leave you with a surplus of $30,000 that comes out as cash that you can put in your bank account. So if you do the math again, before we had $50,000 equity, we had $50,000 of debt. Now we just pulled out $30,000 more of equity into our bank account. And so that's going to reduce our equity in the property from $50,000 down to $20,000. We subtract that $30,000 off our equity in our property because we pulled that equity out of the property as cash and put it in our bank account. And we went out and got a new loan for $80,000. So it still adds up to $100,000. We just have changed the breakdown of debt to equity ratio. We now have more debt in the property than equity, where before we had 50-50. Residential. This is used as a residence or by residents. So it's a law. It's basically a zoning term, like we talked about with commercial as a zoning term. So residential just stands for housing. So it's your apartment complexes, condominiums, houses. It's a local zoning ordinance that. So the zoning ordinance, they're going to pick out different areas of a city that they're going to zone residential, meaning only houses and apartments and condos can be built. They won't allow businesses in to certain areas. They want to keep that area specifically for residents and for people's living. Seller's agent, also known as a listing agent. The seller's agent works for the seller. That's why it's called a seller's agent. So they're going to help the seller list their home on the market and get it sold to a buyer. Single family house. This is a single independent property that is used by a single family for living. So it's, in short, a single family house is just a house. So if you drive around neighborhoods and you see houses in a neighborhood, those are what we call single family houses. It just means it's a house and that one family is living in that house. It's not like multifamily where there's an apartment building that's got multiple families living inside of it. Title. This is a legal document listing the history of ownership of a home. So buyers are going to get a preliminary title report from an escrow agent or an attorney at a title company. And it's typically going to happen pretty quickly when you reach a deal with a seller. You'll go order title and they're going to send you a document that lists out the title history of a property so you can see the past owners and make sure that you are buying the property free and clear of title, meaning that there are no other owners when you take over the property. That way you are now the sole owner of this property and you have the rights to this property. And that's where you're going to get the deed from the seller, which transfers the ownership to you as you are now the title holder. So just think of it like a car. When you exchange a car with another buyer, you give over the title to the car to that buyer, and now they are the official owner. All right, title insurance. This is what protects you against losses that result from problems with the title. So a title company or a closing escrow agency, whatever you want to call it, they're the ones that go run the title search and find out the chain of title and make sure there's no defects in the title. But if they screw up, there could be potential losses where you could be hurt financially, or you could lose the property and no longer own the property. So to protect you against these losses, you can pay for what's called as title insurance. And that's where the title company will basically insure you and say, hey, if we screw up, our bad, we'll make sure that we handle this for you and that you're compensated and you're not in trouble with financial losses. Lastly, we have zoning. These are laws that govern how real estate can be used. Properties can be used for residential housing. They can be used commercially for businesses and office space. They can be used industrially for warehouses and storage facilities and manufacturing facilities. So a government's going to look over their city and dictate different areas of the city that can be designated as residential or commercial or industrial. And they're going to create these different zoning policies and zoning maps that people have to abide by when doing real estate transactions.